All right, welcome everyone to our today's webinar. My name is Tobias, and I wish you a very warm welcome to our webinar on the topic of managing startup runway, liquidity planning, and convertible loan essentials.
Hey
myself,
guys, sorry.
Yeah. Yes, I'm here with Michele from LEXR.
So also a very warm welcome from my side. Happy to have you all here today.
Yes, thank you. Yes, people are still dropping in, but we're starting. So I'm the founder and CEO of Tresio. We're a cash flow and liquidity planning tool. And yeah, Michele, we just heard he's head of startup financing and VC at Zurich-based LEXR. Our topics today, we first want to frame a bit where we are right now, because there is so much noise in the media and so much things like going on. So we just really want to frame a bit what is the situation that we are right now, specifically for us startup founders. There are a lot of founders in the call. And then get into the topic. And first, we're going to look at how do you really set up and manage your startup runway. It's a big topic, so we see how much value we can give you in the 20 minutes that is foreseen for it. And I also want to give you a very simple frame. It's called an APMA. It's 4 steps to really set up your liquidity and runway management in an effective way. And then Michele from LEXR will take over. He will give you some insights how startup funding works. So it's like a general overview. Also, why you should maybe use, or under what circumstances you should use debt, and when equity is maybe more applicable. And then we really dig into the topic of today, the convertible loan agreements. How do you set them up, and what key terms you should really look at. And after these 2 inputs, there is enough time for your questions. Please, guys, use the Q&A function here in Zoom, where you can just drop your questions as we're talking, and we will take them up at the end of the webinar. Just a short notice, we will record the webinar, and if everything goes well, we will also provide you with the webinar without the Q&A session. That stays private, so you can really ask everything there. Everything else will be published to other channels after the webinar. Good, let's start. At the moment, it really looks a bit like we're in a perfect storm as founders. There's a lot of geopolitical uncertainties going on in the world. It has started since some years already. There is this possible shift of global power, like in the last 60, 70 years, it was always the US who led the modern world. And right now there is other like big powers, most of all China, who want this power too. And this alone brings already some instability to the world. Since the beginning of this year, now we also have this war in Ukraine, and it's not enough. As if it's not enough having this war 1,000 kilometers from our doorsteps. It's now also more and more going towards a global energy crisis, and this energy crisis in combination then with also the supply chain issues that we still have, like we might not realize it here, but in China, still a lot of cities have like regular lockdowns. I just talked to a friend over there. She has spent 120 days this year in isolation. So it's like, it's still ongoing there. So we have a lot of supply chain issues. And also, unfortunately, due to this whole COVID thing, we had a very loose monetary policy in a lot of countries. And this all combined really brings us the highest, or some of the highest inflation rates that we've seen since the early 90s. I think, including myself, it's actually the highest inflation ever, or the first time ever that we experience inflation in our lives. So this is really a lot of things that have changed in a very short amount of time. And what we have to know with this high inflation rate is also ended the era of free money that we enjoyed in the last couple of years. And actually in a very abrupt way that we have interest rates again. And this takes its impact and toll on startup valuations. And I want to dig a little bit into that topic first. What you see on the left is the Fed funding rate from the US dollar, from the Federal Reserve. And as you can see, like for almost 10 years. There was with a small hike in from 2016 to 20, when they suddenly had to go back to zero again due to COVID. There was an era of almost zero interest rates, and this in a very abrupt way changed in the beginning of this year, end of Q1, with rates going up to 4% in very short time. And this means that there is now actually the safest investment in the world that you can probably take, the US Treasury note at 4% interest. And that's, of course, has drastically changed. Like before that, in Switzerland, we even had negative interest rates until very short time ago. So the alternative was, okay, maybe I find somewhere a startup to invest, so I don't have this negative interest rates, versus, okay, I can actually get 4%, decent risk-free return. Now, where's the upside and really potential if I make such an investment? So this is one shift that we have to keep in mind, just about our company valuations. But the other thing is the discounting rates. So the reason why, especially SaaS valuations, software as a service startups, and also grown-up companies have been so high in the past, was always because of the future cash flow. Like it didn't really matter how much we all were earning today, but what really counted was the outlook to the next 5, 10, 15 years, whatever. And this was then discounted at a certain rate. Now, if this 4% risk-free goes up like from 0 to 4%, this whole discounting values naturally get very much lower. So that's why asset prices will always go down. Like as soon as a national bank rises the interest rate, assets go down, and vice versa. And this is, of course, a problem for companies, for startups. And on another note, like it's not, as if this was not enough, like the deflation rate going down, it's also that this future earnings got more and more questions in the last couple of months, because it turns out that a lot of these business models, like Facebook, for example, I always thought, okay, this will grow forever and generate returns forever. Actually, more and more investors realize that this forever might actually not be that long as they expected. And this means that having dollar now versus in 5 years became much more important compared to a year ago. So this, just from that side. Now, if we look at company valuations, we always, obviously from private markets where we are it's obviously hard to get figures, but the ultimate buyer of companies is always the public market, right? I mean, there's a lot of private sales, but like if a private equity company buys a company, they always also think, okay, I can sell it somewhere. And like the last buyer of last resort is always the public market. So we have to look at the public market valuations a lot to understand what is also going down on in startups. And if you look at that, that's the graph on the right side. That's like the median valuation multiple compared to the last 6 years. And it was actually like the average was at 8, a little bit above 8. And right now the median is down at 5.6x. So it's always the multiple of your annual revenues that the stocks are trading, right? The average is at 7.1, the median is at 5.6. And that means that the premium companies, like this difference between this 5.6 and 7, means actually just the premium companies with really high growth rates and healthy margins, they're still trading at higher prices. But this 5.6 is like the median, which is obviously a third of what it was last year. And what is to say, or what is important to know, is that this is public markets. Again, for late stage companies, this really has an immediate effect, because they are probably like a Revolut, for example, which is to be said, or that they announced it also, that they are shortly doing an IPO or want to do an IPO. Of course, the public valuations have a one-to-one effect, whilst early stage companies, they have more room and they usually still a little bit less troubles to find capital, but still it got more difficult. And fintech, where we are, is especially bad. It was down 90%. I mean, the multiples were crazy. A year ago, the average was on 25x. Now it's on 3 times earnings. Again, this is public companies and late stage startups where the numbers are from. But if you look at the example from Klarna, I mean, it's disaster. They raised 1.5 years ago for over 40 billion. And then in Q1 this year, they wanted to raise it 60 billion. And they realized, okay, it's not possible. And then they reduced the value step by step. And then in the end, they ended up below 10 billion. And I mean, if you have a down round by 90%, this is really, really bad. Maybe Michele will also outline it a bit afterward what this means, but it's really not good. And it can really destroy companies. And what a lot of industry experts expect is that we will see more of such down rounds, especially in the late stage in the coming months, and many companies also going out of business. And so we really are a bit in an environment, survival of the fittest, if we cannot generate cash flow to actually pay our salaries. So what this means for us as startup founders, really runway management is absolute key in this environment. And you should really start focus on cash right now, like start tomorrow, really focus on spend control, like in a rigorous way, if you're not already doing this. Even if you have a lot of money now, maybe you just close this big funding round, congrats on that, but you will need the money in the next months, because if you can, you should really make sure that you have a runway until end of Q1 2024, or maybe even a bit longer. Like that's, I mean, it's of course nobody knows and nobody has the crystal ball, but it's likely that next year will not be like just suddenly back to these crazy times that we had before last year or until last year. In connection with runway management, discuss your prices, but not only pricing, but also payment terms with your customers. So if you can, for example, you can ask them to pay yearly upfront instead of monthly accruals. There are also debt services where you can go, a float, for example, where you can actually pre-finance your monthly payments, things like that. Just consider them. And what you should also really focus right now is a good time to automate maybe some of the processes. There's still a lot of companies leaving money on the table with the collection and billing process by forgetting it or like doing it after 6 months. Really don't be that guy. Like have a process in place that you really handle the billing and collections as automated and efficient as possible. Then on the supplier side, of course, negotiation again, if you can. And again, not only think about pricing, but also about payment terms that you can discuss with them. If you can maybe pay later or in quarterly areas instead of monthly, things like that. Just try to keep that cash in the bank as long as you can. And that's the next point, actually. Like I always say, accounting is fiction, cash is really the hard facts. And so really profitability is a lot of cosmetics always, right? But having cash in the bank doesn't lie. And that's what you should focus on right now. And I would really advise you to set up the business model once, really. There are a lot of factors that count in, like your churn rate and revenue per customer, et cetera, model it until it makes sense and gives you the runway you need. But then set up a system for the operational daily planning, because you don't want to update this Excel all the time. And one option is, of course, using a tool like Tresio. There are others in the market. Do your homework, but that's what you should do. Now, how do you do this operational task, this daily cash planning? I set up this APMA kind of scheme. If I was a US entrepreneur, I'd probably write a book about it and sell it. It's relatively simple. Like first, you always start with your analysis. Like how much money do you have left in the bank, and what is your current cash burn? Cash burn is your cost basically that you have, and then also what, if you know that, okay, what can you expect as income immediately, like accounts receivables, open contracts that will bring some cash flow, subscriptions that you have, funding that you plan, etc. And this you should really do daily or at least weekly. I would advise daily to have like just have this overview. And this is also why you need a system in place. You cannot do this daily in an Excel sheet. Otherwise, you will spend half your day with it. You should just have a cockpit somewhere, you can log in and have this under control. Then what are your spendings? And how is also the income changing over time? This you should check on a weekly basis and adjust where necessary. And then on a weekly to monthly basis, you should also measure, are you on track with the budget? Is this actually still true what you're doing? Like, and there I would really also run and compare different scenarios. Like, for example, okay, what happens if my revenue drops by 30% or I reach only 30% of my revenue goals? What impact does this has on bottom line cash flow on the run rate? This exercise you should do on a weekly or at least monthly basis. And then adjust finally, like and this, yeah, I do it monthly, and we also advise our customers to do so. Like, whatever new facts you know, and just take them into consideration of your model and see what impact this has on your liquidity forecast. Like, this can be new contracts you won, also customers who maybe canceled the contract. It sucks. HR changes, like more people, less people, changing salaries, etc. So the goal here is really to have like that you as founder, and that's your responsibility. You cannot delegate this to an external trustee or something. It's really your responsibility to have this daily view under control. And yeah, this was a short input now. I'm happy to sit together with you after the call and really look at your situation in detail. All right, that much from my side. Now, happy to hand over to Michele.
Thanks, Tobias, for all the insights. I think that's really valuable. I know that as a fact from all startups that we advise, how important liquidity planning actually is, and that this is something that in the end distinguishes the successful startups from the ones that fails a lot of times. So yeah, I can't stress enough how important that is. And I think it's the perfect segue to also talk about how to actually fund your startup. As you perfectly said at the beginning, we see valuations plummeting. We see that the funding cycles get longer and longer, so it gets more and more difficult for startups to actually get funded. Now, how can you get funded as a startup? I think it's important to distinguish the two most important or most known ways of funding, which is on the one side the traditional straight loan, which means you get money from a lender in return for interest rate payments or interest payments. And then on the other hand, we have the traditional equity financing, where an investor invests into your company in return for equity. And then in the middle, so to say, we have the convertible loan, which is kind of a combination of both worlds, which with which you get a loan first, so debt capital in your balance sheet, which will, however, convert into equity at a later stage, or which will typically convert into equity at the later stage. I use this slide here, I think, at almost every presentation that I do, but I think it gives a good overview over the startup funding cycle, if you will, how it works, where you have the different stages. You have the super early stage on the bottom left hand side, where you might have even received a loan from friends and families, and then on the very right edge, we see the IPO, kind of the unicorn exit, let's say the on case where the company goes public and everyone becomes a millionaire. So in between there are a lot of stages to tackle and a lot of rounds to go through. So let me see. There we are. So what are reasons to use a convertible loan? I think, as Tobias said, the funding cycles are getting longer. Valuations are plummeting. So the valuations came down quite a bit. We see that the market multiples also went down. So is actually, in my opinion, a lot of times the perfect time to bridge a financing or to bridge two financing rounds, for example, with a convertible loan, or to even enter into convertible loan before you even go into your first equity financing round. So why is that? I think first and foremost, the valuation topic is postponed into the future. So if things go the way we hope they go, that you know, the perfect storm as described by Tobias is kind of moving away one day, the valuations will increase again. So you can postpone this difficult topic to the future and say, well, look, at the moment we just need money. Let's talk about valuation when we enter into the next financing round. Second reason to enter into convertible loan, it's a super quick process and it's very cost efficient in comparison to a traditional financing round. So setting up a convertible loan is really something that you can do within a week. More or less you're ready to, or the money's on your bank account. Whereas in a traditional equity financing round, just from experience, although all investors always say that they are super pragmatic and fast, it just takes a month at least from initiating the process until the money is on your bank account. And that's a fast process with a month, just simply due to the commercial register who is involved, a notary who is involved at the commercial register has to enter in the capital increase into the commercial register. So this all takes time. And then last but not least, it goes into the topic of valuation. You can also postpone the question of shareholder rights into the future. So the shareholder agreement typically, I mean, we see convertible loans where the shareholder agreement is already pre-negotiated with the investors, but typically you also postpone the negotiation of the shareholder agreement into the future. And this can especially be important in a situation where your position isn't as strong. So if your cash flow isn't as good as it used to be, when it's just a little bit more difficult to even find various investors that want to invest, your negotiation position is just weak at that stage. So it might be good to also postpone the negotiations of the shareholder agreement, in particular where all the important rights are governed. So one thing, and I will come to that later, is the anti-dilution adjustment and the liquidation preference, where there is a lot of leverage for the investor at the moment. So I talked about the advantages, and as with everything, there are also disadvantages. With the convertible loan, as with all negotiations, if you have a cap valuation, we'll talk about what it is in a second. This can have a anchoring effect on future financing rounds. And then the second one, the 10/20 non-banking rule, I think we can skip for now. Just something to take away is that as a company, don't take on more than 10 identical convertible loans or more than 20 convertible loans with different terms. Otherwise, you enter into withholding tax problems, or you could enter into those problems. So I think this brings us to the key terms of the convertible loan. We have the investment amount obviously on the one side. So how much will the lender or investor provide you with? What are the trigger events? So a trigger event, as already introduced, the convertible loan, basically, in contrast to the straight loan, will convert into equity at one point. And the convertible loan agreement typically foresees various trigger events which will trigger the conversion. The most obvious one is the next equity financing round. So if you get the convertible loan today, and let's say in a year from now you enter into a financing round, this will trigger the conversion of the loan into equity. Other than that, there is the maturity event. So what you want to do is you want to have, or also the investor wants to have some sort of long stop date. So what happens if there is no equity financing round, let's say within the next 2 years, so 24 months, 18 to 24 months is what we typically see. So if you hit the maturity date, then the loan will also convert into equity, typically at a predefined valuation. As a startup, I think it's important to have a maturity conversion as a trigger rather than a repayment, because typically if you reach the maturity date, this means you've been super successful, so you no longer need funding, or things didn't go as planned, and typically you don't have the liquidity to repay the loan. Then we have the so-called cap valuation. That's an investor-friendly term. So kind of if you have the negotiation power to negotiate the way, I always recommend it. It means that even if the next equity financing round that triggers the conversion and thereby also triggers the valuation and the price per share, i.e. the number of shares the lender receives, the cap valuation basically gives a maximum valuation for the lender. So even if you're super successful, your valuation goes through the roof, the lender will, or the convertible loan investor will hedge himself by not converting at the higher valuation than the cap valuation. I think it goes side by side to the next term we have here on the list, the discount. So this is basically both the discount and the cap valuation from an investor's perspective, is the consideration for investing early, investing without the valuation. So the discount means, let's say you have a financing round at 5 million valuation with a 20% discount, the convertible loan lender or convertible loan investor will be able to convert the loan at the 4 million valuation effectively. We will look at this in a second in a concrete example. Then the last topic we did not talk about is the interest, which is also a consideration or kind of a risk equivalator. As Tobias said, now you get with a 100% secure US obligation, you get 4%. So this is a discussion you will probably never really have. Will there be an interest rate accruing on the loan amount over time and then also converting? So you will not pay out the interest, typically will just accrue it on the principal amount and then convert it together or not. A year ago, almost all startups we saw, they said, well, there will just be no interest rate because, I mean, interest rates are a thing from the past, they said, and now they're here again. It goes together, in my opinion, with the discount because they both, in the end, are the additional benefit the lender receives. Yeah, I think typically more important than the interest rate is the discount. So you don't lose a lot by giving 4 or 5% interest rate if you can negotiate down the discount from 20 to 15%, let's say. Maybe as a benchmark, what do we typically see here? So we typically see discounts between, let's say, 15 or 10 to 30%. And I don't know if it's just a Swiss attitude, but most of them end up exactly at 20%. So here we have a concrete example of a convert or how a convertible loan works in case the trigger event is the next equity financing round. So as we can see here, we have a company incorporated with 2 founders, 100,000 share capital, and now they got loans from 3 different lenders, in total 700,000. Here we have some interest that accrued over time, and then the seed round happens at the 6 million pre-money valuation. So this triggers the conversion. So what happens now if you have a financing round? So typically the seed investor will say, well, or the equity investor will argue, I want to invest fully diluted, which means I don't want to get diluted by the lenders. Basically, my price per share is calculated as if the loans would have already converted. So we see the price here per share, 6 million valuation, 49, let's say 50 Swiss francs per share. Now with a 20% discount, the price per share here would be 39 Swiss francs. However, since we have a 3.5 million cap valuation in my example here, the price per share for the lenders is only 35 Swiss francs. So we have a more than 20% discount that they receive. And what that means, I think, is you can see here in the yellow marked cell. So the lender who invested 500,000 Swiss francs versus the equity investor who invests 500,000 basically gets almost twice as many shares as the lender gets twice as many shares as the equity investor. So that's basically what the lender is hoping for, to buy in cheap into a successful company. And this must be your argument when negotiating for a bridge round or for a loan, that this is an opportunity to buy in cheap for the lender. I think one thing that I want to talk about here is just because I think it's important in the current environment is the down round and down round protection or down round mechanisms, or what happens in case of a down round. Because in the last, I would say, 2 or 3 or even 4 years, valuation
We don't hear you anymore, Michael. I think you have a technical problem right now. Yeah, you're back.
Me?
Yeah.
I cannot hear you at the moment. Hello?
Yes, we hear you.
Now you hear me again. Okay,
yeah.
super.
Thank you.
So my device disconnected for whatever reason. So we are in an environment now where down rounds are becoming a thing again. So the investors in the last couple of years, they never, at least in early stages, they never had an anti-dilution adjustment, or they never insisted on an anti-dilution adjustment. Maybe quick side note, what is an anti-dilution adjustment clause? So with an anti-dilution adjustment, and that's important for the founders, this can really hurt you a lot. If there is a down round, the investor wants to protect themselves against that by having a clause in the shareholder agreement which says, in case of a down round, I will get free shares to compensate for the fact that I invested at a too high valuation. And there are various playing forms with weighted average dilution adjustments, broad-based, narrow-based, or full ratchet versions. We don't have to go into the detail, but important is that this can hurt you quite a bit in your equity stake. So what we typically recommend if you are currently in a situation where you have to negotiate a financing round to limit, at least try to limit the time during which the anti-dilution would apply. So only if there is a down round within the next, let's say, 2 years. So this gives you the opportunity to at least bridge around with a loan or a convertible loan, not to enter into a down round. Or you argue vis-a-vis the investor that instead of an anti-dilution adjustment, you give them a preferential subscription right. So basically say, well, look, if we have to go into a down round, you get the opportunity to subscribe for new shares first before we even ask other investors, so you can then also buy in cheap. So at least you must have some skin in the game. And then the last resort would be a so-called pay-to-play provision, in which you say, well, you can only benefit from the anti-dilution adjustment if you at least also invest in the down round. So you cannot just be a free rider, so to say. Yes, I think, I don't know where we are with timing, Tobias. I could talk forever, but I think this would be a segue to go into the Q&A.
Sure. Thank you very much, Michele, also for your input. Yes, are there any questions? There are currently none in the Q&A. If you have questions, just raise your hand. We can also give you the micro, or type it in the chat function, the Q&A function, or whatever. And yeah, maybe before other questions come up, I have one, Michele, to you. So you mentioned already this down rounds. What do you typically see, and from what stage on do I as a founder have to accept it? Like in seed, I understood my understanding is it's quite uncommon. What do you see, and maybe also how do you see the market shifting in that regard?
Yeah, so my argument is always, if there is a down round after the seed round, this typically means the death of the company. So a lot of times, unless you had a super good seed valuation of, let's say, 8 to 10 million, you will just a lot of times not have a down round, because then you will just go bust a lot of times. If you have really good investors that believe in you, they will just bridge you through this valley and hope that you can pick up speed again. Then what we now see is, the Series A valuations, they were super high in the last couple of years. Series B valuations, 150 million plus. There we already had a couple of cases where there would have been a down round, but then we bridged it with a convertible loan. So the existing investors were willing to bridge the round, because also, from a outside perspective, if you're the always super successful startup, you just don't want to have the publicity of a down round on record.
Makes sense. Thank you. Now we have a question from Frederick on convertible notes. What type of investors like to invest in convertibles? Like, is it more a VC thing, financial and corporate? Maybe what of those? Or is it family offices also, private individuals? Or what is like the typical way to use a convertible note?
So we see the whole spectrum. So we have the godfather or godmother of a founder who just invests into the startup via a convertible loan on the one side, and the super tough VC investor on the other hand. The difference is that with I would say, angels, friends and family offices even, a lot of times you just have a straightforward, simple convertible loan agreement with simple terms. If the investors is a VC or a let's say more professional investors in that sense, the agreements get more complicated. You will have provisions such as a most favored nation clause, where if you issue new convertible loans at preferable rates, this will then also apply to those loans. You have gross up clauses, you have reps and warranties, and so on and so forth.
Good, thank you, and thank you also for the question. Then we have a next question from Dave. Michaela, you mentioned that we can postpone the valuation by a convertible loan. On the other hand, we're giving the investors a valuation limit. So there needs to be at least a basic calculation of a valuation, which then is discussed. Do you have recommendations for how to do that rough valuation? I guess for the convertible loan. Thank you both for your insights. Thank you, Dave, for the question.
So, I know what you mean, because typically you have a maturity valuation, which you set in advance. So you talk about valuation to some extent if you want to convert at the maturity event, but you also have the cap valuation in there a lot of times. And what we see here is really, as a rule of thumb, I always say the maturity valuation is what do you think is your company worth today, plus the investment you receive from the lender. So let's say you look at your revenues, you apply a simple multiple, and then you come to, let's say, 1 million, and you get the 500,000 via a convertible loan. Then just as a basic baseline, you could argue, well, the maturity valuation is 1.5 million. What we see from experience, interesting enough, is that a lot of times, the valuations are a seed round almost always is somewhere around 5 million on average. There are outliers, but typically. So I always recommend to say, look, let's put a maturity valuation of 4 million. This is, if we believe 5 million, this we will reach with some certainty. If it's not going well, we will be worth 4 million. That's what I recommend. It's really not a scientific approach, but this is just what we see. And then for the cap valuation, I always say, look, if you can negotiate it out completely, perfect. Otherwise, this should be really the best case of the best case scenario, because from an investor's perspective, you can argue with the investor, look, you have a discount. If the cap valuation applies, this means that we have been super successful. So if we have a cap valuation of 10 million and it applies, you still are well off because you invested in a successful startup. And if the valuation goes through the roof to 15, 20 million, then you get even more. So I hope that this helps.
Good, thank you. And then there is another interesting question again from Frederick. What size should a convertible loan have expected the next equity round? So what should be like, if you plan your rounds, what should be the amount of a convertible loan?
Yeah. So
what's your take on that?
There also, as a rule of thumb, I always advise and say, look, if the investment is below 1 million Swiss francs, it's just not worth entering into an equity round due to the transaction costs that you have. So that's as a rule of thumb, as we see 800,000, 1.2 million, it's fine. So a lot of time we see that the convertible rounds are from 100,000 to 1 million. The early stage convertible rounds and the equity rounds are above 1 million. Of course, if you're bridging between Series A and Series B, then you will get, for example, 5 million in convertible loans. But I think this goes into your field of expertise, Tobias. I think it's super important nowadays to not to take on too much money also, because at bad or at conditions that are not perfect. So really manage your runway and only take on as much as you need if the conditions are not where you want them to be. I don't know. What do you think, Tobias?
Yeah, I think that's well summed up. I would also look at it, not really put it in perspective to future equity rounds, but rather look, what do I really need? Like, and also, see what the market is currently doing. As I mentioned before, it's really recommended right now to have at least money or get money until for the next 1.5 years. I would, if I would raise now. So just calculate how much do I really need to move my company there. And it can also be earlier if you're confident that you reach certain milestones in the next 8 months. You can also gamble and do it until then, and then get worst case a next bridge financing. It's also possible, but really do it from that angle. Like, see what is the burn, what is the runway, and then also simulate what amount should I take on now. Thank you, Frederick, for this question. We have another one from Vincent. As I think it goes again to you, Michele. Can you comment on use of convertible notes for companies that are at the stage of raising a Series B?
So I think this is then really the bridge round where you might not reach your valuation goals. So you bridge around. As said already, I think we see this more and more at the moment, that that rounds are bridged with a convertible loan. One thing there is then also again with regard to the terms of the agreement. Sometimes Series B might already still be too early, but at some stages you forecast and you see, well, if things go as planned, we might not even need an additional funding round. So we just need to bridge the gap, and if everything goes to plan, we might even be able to repay the loan plus interest rather than converting it to equity. And if you have a strong position, you can negotiate a voluntary repayment option by the company.
Yeah, that's a good point. I also think, like, if you're in a later stage, especially now that VCs force you anyway to turn your business model to profitability in some way, if you can do that, there might be other funding options available as well. Because don't forget, like, equity funding, which is always the standard in startups, and it also makes a lot of sense early stage, but it's actually the most expensive way of funding a company. So the later you are and the more revenues you already make, there might be other funding options out there too. Like, it can be a revenue pre-financing. It's becoming fairly popular, especially in the SaaS space also, where you like take your annual recurring revenue and you get like a loan based on this from some specialized providers. There might also be factoring that might be an option, or some other ways. Like there is a lot of debt funds that have been set up, also in Switzerland actually, that really want to invest into successful companies in way of debt. So you don't necessarily always need to give away equity in later stages. In early stage, of course, that's the way you do it. Yeah. Good. Any other questions around? Good. Seems not be the case. Thank you very much, everyone. Thank you also, Michele, that you joined our session today. We actually have every month such sessions from Tresio side. The next one will be on 13 December on how to structure your board of directors. Very often we see, especially with startups, that this is done with friends and family or with investors, which are not always the smartest. I mean, they are hopefully smart, but there are also other options out there. And we will have a discussion with that with Dominik Lüthi. He's the founder of VR Mandat. That session will be held in German, so for those who speak German. Thank you very much. I wish you all the success. And if you have any questions on cash flow planning, liquidity topics, funding, like how to structure business plan, come to us, Tresio. And if you need legal advice, obviously LEXR is a great address with Michele.
Thank you guys for joining. It was a pleasure to
Good.
take
Thank
part
you.
here, and thank you, Tobias, for inviting.